Well, I'm delighted today to be at the Park Hyatt in Dubai, where we're recording a case study with two esteemed guests, Darlene Hart and Sunita Singh-Dalal. Welcome to you both.
Thank you, David.
So we're going to lay out a little scenario in a moment, but before we get into that, it'd be great to have a little introduction to yourself and your practice, perhaps starting with you, Darlene.
Okay. My name is Darlene Hart. I'm the founder and the owner of U.S. Tax FS, for financial services. And we've been in business since 1986. We have offices in London, Zurich, Geneva, and Stockholm. We've got about 70 professionals, all U.S. tax accountants or lawyers and enrolled agents. And we concentrate on the foreign side of the U.S. tax law. We have no offices in the United States, so therefore all of our clients, everything, has a foreign flavor to the U.S. tax law. And we enjoy it. Believe it or not, we do like what we do.
Fantastic. And over the last year, you've been spending an increasing amount of time here in the UAE.
Yes.
You spent the last month here alongside other trips. Perhaps you tell us a little bit about the opportunity you see here in the UAE.
I'm impressed. I am so impressed with the entire region. It is booming. Everything is moving here. I think it's exciting. Believe it or not, it actually reminds me of when I moved to Houston in 1974. It's like that. It's like boomtown. There's a lot going on, and there's a lot of business being done, and I think there's an awful lot of opportunities here. And the reason I'm here is to find out whether or not there's enough U.S. tax-related business for us to be able to open up an office here.
Fantastic.
And Sunita is trying to convince me to set up here.
Sunita, great to speak to you again. You've been a fantastic supporter of our group. For those who've not seen you on our content before, perhaps you could give a brief introduction.
Sure, David. I'm a partner here with a firm called Hourani, and we've got offices headquartered here in the UAE and in 3 other locations in Saudi, as well as a non-U.S. US presence in New York, and a team in Beirut as well. My focus is private wealth and family offices, and as Darlene said, it's a very, very buoyant space to be working in at the moment from an advisor's perspective, and incredibly exciting. And the reason why we're here today is absolutely, I echo what Darlene says, and I think it would be phenomenal if she was to open up a base for her team here, given the vast amount of cross-border advisory work that we see taking place almost on a daily basis, that in some way, shape or form will certainly have a US aspect to it, just because of the demographic between the two geographies. I think it would be a fantastic idea to have some sound US advisors on the ground here.
Great. Well, just to set up the central scenario, in terms of a family structure, we have the clients we're advising, which is Mohammed and Nadia, aged 75 and 62 respectively. Both are UAE nationals with 2 children, one a daughter, aged 42, living in the USA, married to an American with 2 US children aged 8 and 10. We also have a son who was born in the US but is living in the UAE, married to a UAE national with non-US children. And their asset base consists of a family home in the UAE worth $5 million, a privately held Dubai company currently worth $75 million. In terms of their international assets, they have a family home in New York, an apartment worth $2 million, and an investment portfolio worth $50 million, consisting of $10 million in US stock, publicly traded, $5 million in US bonds, also publicly traded, and $35 million in non-US stocks and bonds, publicly traded. So is this kind of scenario, Sunita, something that you would commonly see?
Definitely. Mohammed and Nadia are very, very reflective of a lot of the families that we find here in the Middle East. As I said earlier, with very historic and deep-rooted ties to the US for one reason or another. The interesting fact, though, is until 2018, 2017, when we had the first set of foundation laws that were brought into the UAE, and we now have 3 foundation laws available to us, there weren't really any true estate planning solutions available for families that had a large, significant footprint here in terms of domestic assets. So what does that mean? That means that traditionally there's always been the offshore solution available, hence we have a very robust, vibrant, international, global trustee, advisory, fiduciary community. However, on the ground here, also because of the fact that we are living in a region where forced heirship principles do apply, just as they would in Italy or in France, for example, there aren't that many choices available. So that all changed when we had the introduction of the foundation law, which enabled people to actually use foundations to start to put some sustainable long-term estate and succession plans in place. So instead of using a trust, they would use a foundation, and basically think of it as transferring it out of your personal name into a structure, a foundation structure, which would remain the owner of those assets thereafter in perpetuity. So we're not talking about 50-year trusts, we're talking about in perpetuity, a long-term solution that would exist for the benefit of a group of people as you would so decide. So in the case of Mohammed and Nadia, and here's the tricky bit, subject to tax advice, cross-border tax advice, because in that case study, of course, you've got a range of assets, some of the assets that are based here and some of them that are not. And likewise, you've got people who are Emirati nationals, but also people within that group that are not. And so therefore, to put a structure in place and try to cookie cut something would be disastrous, because the long-term repercussions of people outside of the region perhaps receiving a benefit from this foundation structure could be catastrophic in terms of fiscal and tax liabilities. And that's where it's absolutely important and fundamental at the outset to understand who's in a family, what does the family own, where are the assets based, what are the restrictions attached to each of those assets in terms of can, for example, a US property, could it be owned by a UAE foundation? I don't think so. That would not be the right thing to do. So we don't just bag everything in, wrap it up in a foundation. We work in conjunction with Darlene and her team to understand what are the parameters within which we could create a structure.
And what about the timings? I mean, they could do this while Mohammed's still alive right now, or what would they look at on death, or at what point would the assets be best placed into a foundation structure?
That's a very interesting question and a very important one, because as we know in the region, Mohammed is actually probably one of the younger family patriarchs that we come across. And in the region, there's a very significant amount of wealth that is in a transitionary phase between generations. And the key to doing this successfully is absolutely to do it within one's lifetime, whilst one is compos mentis, that there are no lurking potential incapacity issues that could then potentially be challenged at a later stage, saying, well, that was not a valid arrangement. So lifetime arrangements are definitely key to successful long-term sustainable estate and succession plans.
And as noted in the case study, Nadia is 13 years younger than Mohammed, in all probability would outlive him, and he would, in all likelihood, want to ensure she's well provided for.
Yes.
How could he make sure that she's provided for following his passing?
Well, what happens is when you actually then take assets out of an individual's name and put them into a structure, you're quite able to, and it's perfectly normal and permissible, to attach some rules to certain of the assets. And again, that's your wishes during your lifetime that you then record formally. So in terms of Nadia, we would ensure that she was given a lifetime interest, so that no matter what happens to Mohammed, she is used to, her lifestyle that she's used to, she's able to maintain. So all her needs and wants are taken care of, just as if Mohammed was around regardless. But what is very important to remember is the assets wouldn't belong to Nadia. The assets wouldn't belong to the family members, or for that matter of fact, even to Mohammed. The assets now belong to the foundation. So in normal situations where you have what we call trigger events, such as births and deaths, or marriages and divorces, all of those potential trigger events could come and go, but the assets remain as they are, owned by the foundation forever, as long as they shall be.
I think that is the most important, and especially from a U.S. tax standpoint, because your ultimate beneficial heirs happen to be American, either the daughter living in the United States or the son living here. I think that was right. Okay. So it's important, but it's also very important what assets you put into that foundation. Not everything goes into the foundation.
That's right.
You have to be picky and choosy about what you're putting in there because it does make a difference. And the wording of the foundation makes a lot of difference because you want this foundation, and most foundations here that we've looked at, and I haven't seen all of them, that's for sure, but the majority of the foundations that we've seen would be considered to be trusts under U.S. law, okay? And you would want this to be considered to be a foreign grantor trust while Mohammed and Nadia are alive.
Yeah.
So therefore, they are your main beneficiaries, and the children don't benefit until such time as Nadia and her husband, Mohammed, pass away. But you have to look at the wording of the foundation. You can't just take something off the shelf, and it's important how you deal with that. And I agree with you, you would not put the New York house into the foundation. If you did and it was used by an American family member, that's a taxable distribution to them, you know, for the value of them using the property of their family home, which is nuts. It's crazy, but that's the law. Okay, that's exactly what happens when you use personal assets owned by a foreign trust, when Americans use personal assets owned by a foreign trust. So it's important.
So just looking at Mohammed's position today, so he's got these US-based assets.
Correct.
What's the status quo position at the moment? Before he looks at the structuring, what should he be doing in terms of tax and reporting?
Well, let's talk about the house.
Yeah.
Okay, they've got a home. To the extent Mohammed owns these assets in his own name, especially a piece of real estate in the United States, if he dies, the value of that property will be subject to U.S. estate tax. And since there's no mortgage, the full 40%, you're talking 40% of the value.
There's
they
no
would be
exemption
paying,
limit?
No,
Right.
Well, $60,000.
Okay.
They get $60,000 exemption, which is
On a 2 million property, they're already well into that.
peanuts on a big property. So that would be subject to U.S. estate tax. So how does he avoid U.S. estate tax? When it comes to real estate in the United States, you have to look at, well, what's more important? Is it the income tax law or the estate tax law? So how old is the individual who's owning the property, you know? If he's only in his, 60s, 70s?
Mid-70s, yeah.
Mid-70s, that's still young.
Yeah, absolutely.
Excuse me, that's still
Plenty
very
of life
young.
in him, yeah.
Okay. I would ask him, is this a property that you plan to sell? Do you plan to sell this during your lifetime, or is this a piece of property that tears at your heartstrings, and this is going to be in your family for your grandchildren and your children's children? You know, if it's going to be sold at some point in time, I wouldn't worry about the estate tax issue. Okay, you can buy insurance for that, or life insurance to cover any potential U.S. estate tax. Or you can transfer the ownership of that asset into a foreign corp. Okay, a foreign corporate entity doesn't die. Okay, and as long as Mohammed owns a foreign corp, then he's there's no estate tax issue. Yeah, but there is an income tax issue. Okay, because if a foreign corp or a foreign individual owns a piece of U.S. real estate and it is sold, 15% tax is withheld on the gross sales price. and they have to file an income tax return to determine what is the capital gains, if there is any capital gains. If there's no capital gains, then they get the tax back. But it's a timing issue.
And it's a relatively small asset in their total net worth here,
Yes.
because the bigger issue is the $50 million investment portfolio.
Yes.
So perhaps talk
Okay.
to some of the issues that would arise.
That's the exact same issue.
Yeah.
Because you have real estate. I mean, first of all, he's not going to be paying U.S. capital gains tax on the sale of any of his Google stock or his Apple stock. Okay, so it's not necessarily an income tax issue, but there is an estate tax issue. To the extent he dies owning that U.S. stock portfolio in his own name, then you're looking at the potential of estate tax at the 40% rate, which is quite high. And once again, if he transfers the ownership of those assets into an offshore corp, a corporate entity doesn't die, and he avoids the estate tax on that. But that's not always an answer. You have to look at what he has. Is he a day trader? What's going on? What is it? Because it may hamper his ability to manage those assets and develop with those assets. You have to look at both. Okay, it's not an easy solution.
And in the scenario broken out between stocks and bonds and US and non-US, I mean, what's the significance of differentiating like that?
Well, the reason we broke those out and in those type of assets is because there's a difference between estate tax and gift tax. If Mohammed decides he wants to gift that piece of real estate to his children, and they're both basically American, subject to U.S. tax, there would be gift tax to pay. Okay, so you would not necessarily want to gift that piece of real estate. However, if he made a gift of the stocks and bonds, there would be no gift tax. Both of them carry estate tax, but both of them do not carry a gift tax issue. Okay, so that's why you look at it and you think, foundation. This is the most important. You start looking at what assets you can transfer into that foundation. Now, this is a foreign grantor trust. So in that, under U.S. law, that foreign grantor trust, the U.S. looks at it and says, actually, Mohammed owns it all. Mohammed and Nadia own it all. And so, therefore, they would still be subject to U.S. estate tax, even though it's held in the foreign trust. So you have to look at the potential of using a wrapper, a corporate wrapper, in order to avoid the estate tax issue.
Okay.
Okay, that gets a bit complex, but I'm
just in
sorry.
terms of
It's
looking
just
at-
very important that you look at the type of assets.
Absolutely. And just looking at the total picture, in terms of the structuring toolkit that's available, obviously we've mentioned foundation, there's trusts, there's also insurance. I mean, do you see insurance playing a role? Is it part of the picture? What do you get from insurance that you don't get from the other types of vehicles that clients might look at?
For me, David, I wish clients were a little more aware of the benefits of using certain insurance policies to hedge the risk and to protect them against the risk of the inevitable. So again, very similarly as Darlene was saying, we do find clients with real estate assets in jurisdictions that really there isn't that much that you can do, but at least have an insurance policy in place to protect yourself in relation to the value, which is a significant 40% value against your asset if estate duty were to apply. And another reason why I welcome very much Darlene's presence to the market is because it will help us start to spread a better degree of knowledge and awareness amongst clients, to start to get them to almost automatically embrace these solutions as the norm, as opposed to the exception. There are assets that won't need, of course, to be wrapped and protected with insurance policies. And the assets that are permissible and quite capable and would be beneficial to be owned by the foundation should indeed be transferred into the foundation. But as Darlene was saying, and as I was mentioning earlier on, the secret to getting this right is the preliminary analysis of who's got what and who is where. and what restrictions are attached. And what we must do first and foremost is together consult, review, and come up with a bespoke solution. But the collaboration doesn't just stop there. The next step would then be, well, whatever we are drafting here and putting in place and creating in terms of the foundation, indeed must look and resemble and appear to be, if we're talking in terms of the US family members, must appear to be similar to a foreign grant or trust. Now, we are based here in the United Arab Emirates. We are not US experts. So what we would do then is work, again, in collaboration with Darlene and her team, to ensure that every line that's written into the foundation constitutional documents, the bylaws, if you like, the governing provisions, do not jeopardize that characterization of a foundation as a foreign grant or trust. And that's where there's a lot of back and forth that is required. Sometimes clients appreciate it, sometimes they don't. But it's absolutely a prerequisite, because a little bit of planning, careful attention in the early stages will provide long-term, potentially tax-free benefits or tax-efficient benefits to the family members who will continue to enjoy that wealth.
And more broadly, looking at the succession planning, we have a private company with run by a father with a son resident here. Perhaps, we don't know from the case, but perhaps ready to take over that business and carry on driving value. We have a daughter who's living abroad and benefiting them equally, and discussing their views for how the children benefit, how they're involved in the wealth, is a very thorny issue, isn't it, that would need a huge amount of exploration. I mean, how might you start exploring some of that, where we have a family business as an engine of wealth in this scenario?
I think the first point to start in such situations is understanding, and here, as you've said, it's a substantial family business. So for us to understand what is the future of that business, regardless of Mohammed running the business and being at the helm, or taking a step back and enjoying life and passing it on to his son to run, or perhaps the grandchildren. So understanding if that's going to be an asset that remains within the family, and also remains the kind of crux of the family wealth that continues to feed everybody. If that is the case, then it would be advisable to ensure that even the ownership of that company is transferred into the foundation. And what we could do is, again, create a foundation with a structure that becomes a very tax-efficient structure as well, now with the onset of corporate tax that we've got here in the UAE.
I think, if you don't mind, I think the most important thing is, and especially if you're going to be transferring a major asset like that into the foundation, is the wording and making sure it is a foreign grantor trust. But at death, at his death, and this is the most important part, at his death, and you don't know how many subsidiaries he's got, and maybe this is a holding company and you've got operating companies underneath it. Who knows what you have here? But you have to look at that structure, and you've got to review that, not just the day you put the information in or put the assets in, but every 5 or possibly 10 years.
Yes.
Because the laws change, things change, and it's important, especially if you've got underlying assets. The character of this trust will change from a foreign grantor trust to a foreign non-grantor trust, okay? And that has a huge benefit, but it also has some downsides, okay, for your American beneficiaries, okay, or potential beneficiaries. Because at some point in time, and according to our scenario here, it's going, the intent is the mother and the 2 children will obtain or become one-third owners of this entity, or beneficiaries of this entity. While Nadia is alive, that foreign grantor trust, she's got to be the only beneficiary. So she's going to be the major beneficiary during her lifetime. Okay, only at her death do the other 2 children then become what we call beneficiaries. But they are secondary beneficiaries, not primary beneficiaries. So it's important, the wording here. Okay, and Otherwise, you're looking at a potential controlled foreign corporate issue. And that comes up very quickly, which means additional potential tax liabilities for the American beneficiaries.
Yeah.
Okay, so it's very, very important how you do that and the way that happens.
We're primarily advising Mohammed and Nadia here, but
Correct.
in terms of the implications for the daughter in the US on their own affairs and how they might receive if they receive a
And
gift.
what the son who lives
Yeah,
here is an American citizen.
absolutely, yeah.
And if he doesn't give up his U.S. citizenship, then he's going to be subject to, and you've got nothing but huge, more than 50% ownership by Americans, controlled foreign corp potential issues, and potential guilty tax issues. And let's not even get into that. But it becomes complex, okay? And it's important that you, and what happens under, under local law.
Yes. No, as you can see, as Darlene's just illustrated, it's not a one-size-fits-all solution. I mean, some of the possible solutions could be is creating another sub-foreign grantor trust where we're ring-fencing some of the benefits for the future family members that are non-UAE persons, for example.
For example, the grandchildren living in the US, I mean, you could have a vehicle for them set up for very specific purposes as well, perhaps, so that in the bespoke structuring, they could be provided for separately or not. How often would you see that where there's a specific vehicle provided for, say, an education or certain purposes like that?
Yes, we do see that quite often because, again, here it is the norm to actually be cognizant of one's future descendants and to have a provision put in place. And if you have it put in place for a specific purpose, then that's very clearly defined at the outset, which I believe is far more
I think
useful.
it is. It's much better. And in fact, what we see quite often are trusts where there's one family member has special needs, okay, and provisions are made for that individual, even before death. Things are set up in place to make sure that that individual is taken care of for his life, not just a short-term time frame. But go ahead. Sorry.
No problem.
But you see, David, the converse is not doing anything at all. Right?
And that's the worst. That is the worst.
And indeed. So although some people may think, my gosh, that sounds very, very complex, very, very complicated, is it really worth doing this? Well, my question to them is, if you don't do anything, what happens? Well, what happens is a business that Mohammed and Nadia too have worked very hard at establishing, a very successful business, have built up a significant amount of wealth in the region. If nothing is done at all by Mohammed during his lifetime, then yes, indeed, upon Mohammed's passing, his wealth will be distributed, as it would in any other country that has forced heirship provisions, in accordance with the ratios that are laid out in Sharia. It's a way of life, so it's not something that one can try to circumvent or ignore, for that matter of fact. But that's what happens when Mohammed passes away. Now, what happens if Mohammed still owns most of the business in his own name? Let's assume he's 100% shareholder of that $75 million company in the UAE. But Mohammed doesn't pass away, but he's incapacitated. And incapacity could mean a long-term illness. Incapacity could mean you are comatose, you are suffering from dementia, which very sadly is something that we see a lot. Then what do you do? Well, frankly, you can't do anything. Then you're just stuck. And you're not only stuck in terms of the onward devolution of that wealth and distribution, but you're actually stuck in relation to the operation of the business on a day-to-day basis. So
Decision making.
All you're doing is kicking the ball further down the line, and you're prolonging the torture and the inevitable. Most families now, with the introduction of foundation laws, and as I said earlier, we have 3 sets of foundation laws here. Most significant business families are arranging their affairs during their lifetime as inclusively as possible for the entire family as much as they can. We certainly are seeing it. We're seeing a lot of cross-border hybrid solutions that we put in place. Yes, they take time, but it is certainly worth it. And the secret to the success of those structures is to continually, as Darlene said, revisit them periodically. The more evolved and organized families would have what we would call a family retreat once a year, maybe in Geneva. Maybe in Zurich.
Sure.
And they would go away and they would use these opportunities to revisit their structures. They would use these opportunities to discuss issues. But also reflective of the region is they would use these opportunities to revisit their governance procedures and the policies that they've put in place. And with those policies would come inevitably a reviewing of, well, who's based where and have there been any changes? What preemptive measures do we have to take to protect the wealth from such potential changes or changes that are about to happen? So,
and one of the things that I have to insist on, for anyone who is setting up these foundations is to make sure they have annual books and accounts.
yes.
Okay, this is mandatory. Okay, and for every entity that is owned by that foundation, because too many times I come across, I have to give you a horror story here. I have a client who was a Hungarian gentleman. Anything he touched turned to gold. It was wonderful. It was amazing. He had a 50-page memo from PwC written back in the 80s, okay? And this man followed that letter, followed that memo to the T. He had a trust, which he had a wife who was an American and 3 American daughters. So he was Hungarian. They lived in Hungary, and he actually sat down and had an excellent trust set up, and he had a holding company, and that holding company had 40 operating companies. And those 40 operating companies were worth over 100 million. Okay? That's how successful he was. Did a great job. Nobody kept books or accounts at the trust level, and nobody kept books or accounts at the holding company level. And I thought, oh dear. And they changed the corporate entity from a GmbH to an AG. And you just kind of go, oh dear, I can't make a check the box election here. No step up in basis for all of those assets, only step up in basis here, which means we've got capital gains from all of those entities that were being sold. It's a total disaster area. And it started off so good and so nice, but it fell apart somewhere along the road. And I think you need to make sure that
having
these
the right professional
foundations,
administration
Yes.
is key, isn't it?
There's also one other point that's very key, and I think Darlene will certainly agree with this one, and that's a very common one that we see, is that family members not quite understanding
yes,
that there are certain roles that can be played
yes,
by certain family members who I call the neutral family members, i.e. the UAE residents, the UAE nationals. And there are certain roles that should not be played by family members. So where you are having a significant involvement in decision making, where you're taking decisions relating to investment activities, etc., anything that will have a material impact now or in the future should not be taken by somebody, for example, in this context, a US person. Because straight away you have then technically exposed the object of your decision making to US fiscal legislation. And that's something, again, that we find clients don't quite always appreciate, and you have to then, and that's where, again, we would work collaboratively with Darlene to almost at the beginning write out a do's and don'ts memo. So this is what you can do, this is what you should not be doing, and why.
exactly, and why.
And again, even that memo and that process, down to the minuting of meetings, down to
Yes.
understanding who should be where and when certain certain meetings are being held, is very, very critical. Revisiting that advice to remind everybody is very critical, so that one inadvertent faux pas, again, does not jeopardize everything that has come to fruition up till that point in time.
And one of the things that I'd like to also bring up is the whole concept of management and control and ownership of various assets in various jurisdictions, you know. And when you're talking about an American who has not necessarily, maybe they're shareholders, but they don't necessarily have control, you know, you're talking about issues here from an income tax standpoint, from a U.S. tax standpoint. I would assume also here, now with your new corporate law,
Yes.
where is the management and control of various entities? And when you have a foundation and you're putting assets into that foundation, who has the management and control and who has what rights? And I think this is really what Sunita is talking about.
Yes.
I think you're
Central
100%
management and control is something that clients, if they haven't been given the right advice, it is actually so easy to get wrong. That one small slip up can have catastrophic effects, and that's where the devil of the detail in terms of the type of advice and hand-holding and supervision, the engagement, the continual engagement with the clients is absolutely critical to getting it right.
Fantastic. And Darlene, I mean, Sunita explained the do-nothing position is not credible here for Mohammed on his estate planning, and in the US, do-nothing position is not credible. Perhaps you could explain a little bit about expatriation, or those who are outside the US but with obligations that need to be sorted out.
Well, the son could very easily give up citizenship. Well, I don't know anything about the assets that he has or what the ramifications would be for him giving up citizenship, but yes, it's always an option.
That'll be computed.
But it is something, I mean, if he never plans to go live in the United States again, he could most definitely give up his citizenship if he chooses. The daughter, who I think is living in the United States, if she's not there, if she's there on a visa, I would have to say, well done, somebody advised you well, rather than on a green card. A green card can be the kiss of death as far as tax law is concerned. If you plan to spend more than 7 years in the United States, 8 years, you're looking at being subject to the exit tax. If you live in the United States and are considered to be a permanent tax resident, a green card holder, for 8 out of 15 years, you are subject to the exit tax.
Which is a lot.
Which is a lot. You know, and people don't quite realize this. They get all excited about getting a green card and they're going to go live in the United States. And that's not necessarily good if you have a lot of assets or are about to inherit a lot of assets. You want to look at that position. Maybe it's not a big deal. Maybe they don't, you know, a lot of people say, whatever happens in tax world happens in the tax world. And this is where I want to live because this is where I want to live. That's fine. Just be smart about it.
And so, Sunita, just to conclude, I mean, what would the top priorities be for Mohammed and Nadia? We talked around a lot of issues. What's the key thing, if you were meeting them, you'd be flagging front and center with them?
The first thing, although it may sound very simple, is to understand how well informed all the family members are about the proposed plan of action. How well do they understand what Mohammed and Nadia wish to do and why they wish to put something in place that will protect the wealth and preserve the wealth for the generations to come. And that, again, is very, very critical, because if it hasn't been an inclusive consultation process, then the actual validity of a lifetime arrangement, and we are talking in relation to Mohammed and Nadia, who are a Muslim couple, that entire validity of the lifetime arrangement could then be challenged in future by potential future disgruntled family members, just as disgruntled family members feel free to, feel that they might want to challenge the provisions of a will if they haven't perhaps benefited in a way that they wanted to. So nobody can take away that God-given right of challenging something. The point is, what defense have you put up in advance to withstand such challenges? So that again is a very small but very key element to ensure the future success of this arrangement. And then the second point, again, as I said, is to understand, to assess, to evaluate, to take everybody's requirements into account, and then to start collaboratively understanding what are the frameworks and what are the restrictions that need to be taken into account before we start to put something in place. It does take time. It's not an open-ended exercise at all. It can be done, if it's done very efficiently, within less than 12 months. Absolutely.
Needn't be drawn out.
No,
if everyone's
not
clear.
at all.
Yeah.
No, and it shouldn't be drawn
Yeah.
out. But it is an inclusive process, and it's certainly worth it, because, as we said at the beginning, what if he doesn't do anything at all? Well, that's just not worth talking about.
Darlene, I mean,
I agree with you wholeheartedly, and it's very difficult to get people to sit down and to focus on this stuff. It hits too close to home, and they have to think about their own death. What happens after that, and it's a very, very difficult thing for quite a few people to actually sit down and deal with it.
what would your top line advice be, or what would be the things from this fact pattern that you'd say to Mohammed that and Nadia that they must consider?
I would have to say, please think of your children. Don't leave them with a mess.
Yes.
Do not leave them with a mess that they have to deal with. I see it too often. I truly do see it too often, and I see no wills, or and then the siblings are arguing over who does what where and what goes on, and stop it. Just your family is too important. Your family unity and how you deal with this wealth is very important. Okay, so that's my only advice.
Many thanks.
Do something about it. Don't sit and ignore it.
Absolutely, take action. Well, Darlene, Sunita, thank you so much for talking to me today, and we look forward to sharing this interview.